this really is an impressive panel, so they do deserve applause before and after. And to just kind of highlight it, because a lot of times when we ask LPs to describe themselves, they maybe say like one or two little things. But Chloe Dagnall, principal at Isomer Capital, they have done 87 VC investments, including the likes of Kindred, Seedcamp, and many, many more. Chloe's also hosting at the Cap Table podcast, highlighting female investing talent across Europe, along with the EU VC team. Christina Brink is, as Andreas mentioned, leading Volvo Group Venture Capital, not to be confused with the other, the previous Volvo Group, and has invested in funds like Plug and Play and Zakua. This is all on everyone's websites, by the way, so I'm not divulging anything, I don't believe. And that's after 20 years of being at AP6, the sixth Swedish national pension fund, and now investing in logistics, efficiency, electrification, and climate tech. So coming full circle after an MS in industrial engineering. And Ertan Khan, whose story you've heard, they've done 56 investments, 10 in 2024 alone, and one already this year. So if you're asking for who is an active LP in this room, you could have no better speakers than today. So I want to dive straight into some questions. We don't want to talk about what definitions are of what deep tech is, but I do want to ask each of you, maybe starting with Chloe and working down the line, how do you describe where deep tech fits into your portfolio, if it even has a special segment?
Yeah, I don't think we feel like it has a particular place. What we're trying to do when we build our portfolio, when we're looking at European venture, which is what we're focused on, is, okay, well, who are the best funds out there? What are the 20 VCs that we want to back that fit our strategy, which is early stage, emerging Europe, funds sub 150 million in size, that we think are going after the most exciting technology companies today? Now, the reason deep tech fits into that is because we feel like some of the most exciting technology companies that are being built today are going to be in the deep tech space, right? So we don't necessarily go out hunting for specific sectors, but what we do is try and cover what we think are going to be the best and most exciting and promising technology trends of the next 10 to 15 years. And then on top of that, we're looking for GP thesis fit, right? So why does this fund, strategy does not get you a spot in our portfolio alone. It has to be, why are you as the team being able to deliver these great returns? And I think that's how we really think about it within our portfolio.
Great, thank you. And Ertan, would you like to cover that as well?
Yeah, sure. Are you still hearing me with that, or should I? Yeah, okay. I think it's very similar. The one difference, I would say, how we approach investing into funds is probably we are what we call agnostic. So we don't have a say or a thinking or a deep knowledge about any of the verticals we do. What we typically do is we try to listen to a very broad number of emerging VCs or VCs, and then those we think are the smartest, with the strongest thesis on specific areas, we tend to back. And that was, for example, to give an example, 6-7 years ago, the first AI fund we backed when AI was still like a kind of a technology where people said, it's not really applicable. And I think back then this person was really convincing and very, very deep thinking. And that's what we today need. And today, in today's market, reality is that almost every second fund in the last year was a deep tech related fund. But that's not because we believe deep tech is the sector to be in. It's because those were the best managers we have seen. So we always think that we don't know which sectors in the next 5 to 10 years will be the strongest. It could be gaming. It could be life science. And life science a few years ago was not deep tech. Today, life science is definitely part of deep tech, if you think, and a lot of things are part of deep tech. So it's very, there is a big overlap of technologies. That's why we are very much focused more on the manager and less on the topics.
And Christina, do you take a different approach than, it sounds like both Chloe and Ertan, in terms of manager selection versus segments or deep tech as an investment vertical? Or is it similar?
As you know, Volvo Group Venture Capital, we are a CVC, and we have a mixed strategy based on both direct investments and fund investments. And one reason why we have fund investment is that we can get access and exposure to deep tech, because we have a fairly concentrated portfolio, and it is difficult to bear tech risk, deep tech risk, in a concentrated portfolio. So we see funds as a good tool to get access to this promising but yet not proven tech areas. And as the panel has mentioned, that we don't know which tech that will succeed in the future. So yeah, that's one way of using funds for us in the venture team. And then it's also important to remember that Volvo Group, we are kind of a deep tech company because we combine hardware with software, and we look a lot into new innovations. So one way of us as a venture team to bring value to our mothership is to source and find interesting deep tech companies that we can channel and share with our colleagues within Volvo Group. So we as a team look a lot for deep tech, but we not always invest ourselves.
It's a perfect tee up. Chloe, I want to ask you, do you feel like deep tech in general, or let's say even just this next trend of technology, has a different place on the risk-return curve?
I think it depends what part of it you're investing in, right? And so, you know, ultimately, hardware has a much different kind of risk-return profile to software because you've got a whole batch of supply chain issues that come with that as well. We're living in very unstable geopolitical times. There's lots of movement there, so it's an additional layer of risk on top of, you know, something that is something already inherently hard to do. But I think at the end of the day, the outsized return there can be huge. And so it's the risk and the game that you're playing. It's why portfolio construction is really, really important when it comes to deep tech. We don't really like deep tech funds that are too specific on one vertical, or like just hardware or something like this, because you get this same problem time and time again, right? So it's about building a fund that has different types of risk return profiles within it, I think, as well.
And Christina, actually, I want to ask you if, looking back at the track records you've seen, does this new generation of deep tech, it may not look the same as some of the previous track records. Does track record matter as much as it used to? And will exits from the previous generations, primarily software plays, as we just talked about, will that be as indicative of what's coming next as we may have assumed previously?
Yes, I like track records, but it's also very difficult to find good and consistent track records, because when you make a fund investment, you need to almost go into individual level on whom has actually sourced, made the investment and made the exit of a specific company, and in total generated returns to a fund. But I would say that in the last 20 years, VCs have made good money and good returns on software-driven, software-based business models. And now that is more or less a commodity, I would say. So the next generation of VCs, they need to learn about how to make good investments in deep tech, because that is kind of back to basics, because venture was an asset class before internet was invented. And venture has provided good returns over time. And what I think is driving the returns are that it's tech innovation. It's not based on leverage and other value creation strategies that you have in buyout. So it's more about tech innovation. And we see a tremendous opportunity in tech innovation now when you have the AI, you have the quantum, you have new materials, and also this biotech-tech convergence. So I think that there is huge opportunities for venture type of high returns, but it is difficult to look on past track record on fund level, because often you have shift of generations in the team. So as an investor in fund, you need to try to find the pattern, but also dare to live that you can't see all the answers and all the patterns when you make an investment. It's about believing in the segment that the fund is targeting and believe in the managers and the investors at the fund.
And does the panel, and maybe Chloe, I can ask you this, do you feel like those same historic track records, do they justify everyone in this room investing more in venture? Do they justify the pension funds, the bigger investors, all to put more capital to use?
Yeah, I think there's some incredible companies out there, and there's some incredible teams that you can invest in terms of the venture space, right? I think it's also about spending a lot of time in the market, and you know, you have to speak to everyone. I think we track 1,600 underlying managers just in Europe. You have to speak to everyone to get a good idea of who's good, right? You have to be thinking about this sector of the market a lot. It's not as easy as I think people think. There was this nice time, as we all remember, in 2020, 2021, where everything was going up and to the right, and of course that bubble has well and truly burst. You see, just with yesterday's news around Deep, whatever it is. DeepSeek, exactly. That's one I wanted to call it, DeepSet, and that is a portfolio company of ours. Not that one, DeepSeek. You see how unstable the markets are when it comes to these new tech and innovations, right? And so you have to look for teams that really understand the space that they're investing in, that have the long-term motivation, that have the alignment to do this, as Ertan was talking about, for a long time. And usually if you just scratch the surface of venture, you might get lucky and find one, but ultimately it's about being dedicated and spending time in this space and really understanding all of the different intricacies and drivers to find the best funds out there. But I think, of course, it makes sense. I wouldn't be working at ISMA if I didn't.
Yeah, good. And Ertan, maybe going back to your experience having companies in portfolios exiting across the world, where has most of that exit capital been driven by? In the U.S., in Europe, elsewhere?
The biggest were in the U.S. So the biggest exit we had was in the U.S. But other than that, I think the exit market compared to the entry market is very global, right? So the entry market for us is Europe, right, most of the time. So we invest in European funds, and most of those European funds invest into European companies at the earliest stage. But if those companies become exitable, so let's say they become a unicorn or even a 200 million euro valuation company, or what I mentioned, 100 million euro valuation company, then those exit markets, people have to realize, are global exit markets. So if you have a strong company today that you can exit, then, and let's say it's relevant for Google, Microsoft, Meta, Nvidia, then they will offer to buy this company, and you benefit from the, I call it valuation arbitrage, by entering at a lower price in Europe and exiting at the same price as US companies in the US. So for every larger tech exit, my IPO candidates, it's always US, in my opinion, for tech companies, or even better, it's dual listing. So, you know, what most of the US companies never think about is, you know, if you're like a very strong outcome in Europe, naturally it's a US listing, but then at the same time you can also list in Europe and benefit from both buying markets.
Mm-hmm. And Christina, when you are, like, let's go back to your time as at the pension fund. I'm curious to know, being in Sweden, I think it's really apparent how much pension money has gone towards VC and private equity in general, but the rest of the European continent and even the UK has not caught up to that. Where do you see, what has held them back on the decision-making process? Is it compensation? Is it alignment? Is it risk-taking? Is it culture? What's the main holdup from your peers in your pension fund days?
You meaning that the pension funds is not investing enough into venture?
Right, or maybe are they investing enough? But that's the market.
I think it depends on how much capital you can deploy, because if you have a really large pool of capital, like billions of pension funds, you need to make that in a cost-efficient way, and the most cost-efficient way to invest in private equity and venture is to pick large buyout funds, because then you can invest like $500 million in one commitment, and it is as much work to make such a commitment as it is to make a $10 million commitment to a venture fund. that has maybe $100 million as a total size, because I think 10% is the maximum exposure you should have to one single fund, and it's also good for the GP, not having too large LPs. And such a small commitment, that doesn't make a difference. It's the same logic as you mentioned, that it's in a big fund, small commitment doesn't make a difference. But also, I think having venture in your portfolio, if you are an investor of large pools of capital, you need to understand where value is created. And since tech is a driver for value, you learn a lot from having venture in your portfolio. So you should consider investing a small proportion of your total capital. One, because you will get fairly good returns on that pocket, but also that you will gain learnings that you can apply on your buyout portfolio and other type of asset classes that you probably have. So when we build out the venture portfolio, we also at the same time added more software-driven buyout managers, because we could actually understand why such companies would be better in scaling than the more traditional buyout strategies. So the venture learnings made us better investors in general into private equity. And I am not a fund of fun, but I can say that a good way to start investing in venture without making all your own due diligence is to pick a fund of fund, because then you will get access and exposure to several different segments, geographies, sizes of funds. And if you like the asset class and then would like to build your portfolio, you can still have a fund of fund as a tool to get access to maybe like micro funds, which is very difficult to invest in at scale. But still you would get that portfolio exposure. So you can, being a manager of a large capital pool, think through the portfolio strategy and try to add venture exposure.
A perfect tee up for Ayrton's entire thesis in the last moments. But
I think you wanted to say.
I wanted to go
happy to share some thoughts on that. I mean, it's I mentioned that that website CalPERS. I think it's if you search for CalPERS, it's very easy to find, and it's one of the largest pension funds in the U.S. And if you look at the funds, I think they have 320 funds on publicly listed with the details on returns. You realize, I think we did the math a year ago, 9 out of 10 funds are below 2x. So maybe it is reasonable, or larger allocators should rethink if it's worth to look at funds that are smaller and where is more work, of course, in the end. But maybe it's worth to have that work if the difference is just 1x. If it's just 1x on the kind of capital you deploy, it's huge. So it would be worth to have even 100 people or deploying through fund of funds to cover that. I think, again, it's like a thing, and the bigger the allocations, so you mentioned about 500 million into a private equity fund. So that equals, and if it's 10%, it equals a 5 billion private equity fund. So those, the larger those funds get, as I said, I think it's harder to return those funds with a interesting enough return.
And Chloe, I'm sorry to cut you off, but it looks like Chloe also had either a detracting point to that, or
yeah. Well, I guess my point was kind of more general on how we think pension funds should be thinking about this part of the industry, right? I think we come from La La Land, where we all pretend that venture funds are only 10-year life cycles, and we all tell each other the same story, and some of the best ones they really get there very quickly, but I think particularly in deep tech there can be very long hold periods, right? And so you're looking for this very patient capital in some of these places, especially in some of the scale up capital that is needed in the European space. And so it's the kind of perfect role for pension funds to play. I think we think about ourselves investing early. You know, we know that some of these are going to have really long hold periods, but we've also invested in very small funds that we hope maybe will make good use of secondary transactions or things like this to exit their positions earlier and create shorter term DPI. But ultimately, like, the deep tech space needs patient capital, and I don't think that, and I think it's a missed opportunity effectively for some of the bigger asset allocators.
So if some of the biggest asset allocators aren't doing it, what is holding that decision making up? And Christina, you pointed out the man and woman power needed to get there is tough. I get that. But what keeps, and one question I might have for the whole panel is, do you see other funds not getting sufficient upside at the pension fund or family office or fund-to-fund level to incentivize them to take that risk that invests in the earliest stage, highest returning managers, like multiple and kind of target audiences?
Complicated
May I
question.
say no?
Is the incentive structure well aligned?
Yeah, I think it's a lot of work being an LP, and you need to understand the underlying market. And sometimes it's easier not to start investing because since still venture is an asset class that is not a commodity in all portfolios, it's easy to make the wrong decision. And if you make that decision, you will hear it. So I think it's because it's a bit difficult, but still good returns, a good upside if it works.
Ertan, what do you
So
think?
one way to answer in a broader way to this question is probably if you look at the larger allocators in the US, some of them have an emerging manager or micro or VC strategy. Even the largest, some of the largest endowments who are tens of billions think they have benefited over the last decades a lot from those very, very early stage venture funds. So but what they also do, what we don't see at the moment in Europe, at least in my opinion, is they use a lot fund of funds. So of course they are sometimes far too large, and they can't invest into a 50 million fund, right? So you can't invest into most probably not into a 50 million fund. So what they do is they allocate into fund of funds that invest into those very small funds, and that leads that our competitors in the US are like 10 times the size that we are, right? So it's a natural move for them because they raise from institutionals that understand the micro VC. I'm not even talking micro VC, but let's say smaller VC world is generating very interesting returns. So the endowments understand that, and they allocate it already for decades into that, and more endowments do that today in the US, and that makes, for example, and they use fund of funds to do that, and the fund of funds are much more have much more power by raising institutional capital, whereas we raise from individuals, for example, in Europe, right? So it's a very different fundraising story. It's a very different deployment story because who is deploying in the European ecosystem? It's not the big fund of funds like in the US. It's the government funds. You know, unless we solve this issue and move it from the government in Europe to private fund of funds like Isomer or others, then we still have governments as the main driver of the European VC ecosystem, where instead it should be private fund of funds backed by institutional capital, backing small VC funds and generating those returns for European institutional capital. Because what happens today is we get more interest from US institutional capital. Think about that. You know, US institutional capital play, okay, you are allocating into European early stage VC. We know that seems to work. We've seen the data. Now we can invest through you into that ecosystem. So instead that the Europeans call us and say we should be maybe allocating through you into that asset class, US is calling us.
You've brought up a conundrum that I'll leave off in the interest of time for, but I have one last.
I think we do have to let Christina.
Of course,
one
it's
reply.
I'm thinking about how the large pools of capital are allocated, especially in the Nordics. We have, by history, large pension funds, we have large insurance companies, and that's it. It's not that many large corporates who have their own pension funds, or it's not that many endowments. So we have built a financial system that goes with very large pools of capital. In Germany and in the UK and other European countries, there are many, many more smaller LPs or potential LPs. So it is actually extra difficult to raise capital as a VC in the Nordics because we have so many very large LPs and not that many smaller ones. And I think in the US, it's also many, many more LPs in the mid-size.
I agree, yes. I agree.
That sounds like a perfect place to end it. Thank you so much for the panel. Andreas, will pass it back to you.